Let's do some stock analysis with Chris Conway from the Australian Stock Report. He is live this morning in our Melbourne studios. And Chris, welcome to you. Maybe we just kick off with the current market to be in business that's come online in Japan and what it signalled to you, I suppose, just yesterday, that pretty, unfortunate is an understatement, the move into bear market territory. Does it give you a sense that we must inevitably go some way towards that level ourselves soon?
Good morning, guys. Yeah, Carson, look, I think we are headed there. There's a lot of fear out there. There's a lot of panic out there at the moment. I'd been talking recently about some risk points on global markets, 1870 on the S&P 500. Everyone knew about that one. And locally, I was looking at 4900. Now, both those levels have been breached. Today is a bit of a furphy. Yeah, sure, we got a nice bounce on Wall Street overnight, a bounce in oil prices, and I think local traders and investors have clung to that today. But those levels have given way, and I think they're significant because they represent a shift in people's thinking about how to price equities. And the other concerning and very alarming factor is that there's very little support below the current levels. I think it's 1550 on the S&P 500 and about 4630 on the ASX 200. So if we don't reclaim those levels and reclaim them fairly emphatically, I think we are headed lower.
The connection as well with US reporting season, which by all accounts just underscores how overpriced that market has gotten, how ahead of itself it has become, and maybe this is now the start of something similar to Japan, a concerted pullback.
Yeah, well, I think so. The rough estimates, depending on who you listen to for the US reporting season, is that we'll get negative earnings growth of between 4 and 5.5%. It would, of course, be the third quarter in a row that we've seen that, and that would be the first time since the third quarter of 2009. So absolutely, as you say, it represents that the US market is overvalued. We all know that it's flown higher on the back of cheap money, which of course is starting to come to an end with US interest rate rises. Throw into the mix China, throw into the mix massive structural oversupplies in a number of commodity markets. You'll forgive me, Carson and Ingrid, but I'm back in bear mode. I'm struggling to see the positives.
Okay, well, what do you make of the rally then? The 1.7% rally on the local market today. Do you see this just as a temporary upswing, a temporary bit of bargain hunting, and you see it going negative again?
Yeah, most definitely. I see today as absolutely bargain hunting. Like I said, I think traders and investors locally, look, we all want to be buyers. We all want the market to move higher. We've seen a 250-point bounce on the Dow overnight. We've seen oil prices bounce from their lows, and that momentum has carried through to today's session. But I don't see it lasting very long for all of those reasons that I've mentioned previously. And look, a really good indicator to me, I know it's only a couple of pieces of data, but today we've seen Woodside come out with their second highest annual production. OZL have said that they've produced record amount of copper. And there was another one in the lead up, Ingrid, that you mentioned had a 40% increase in coal production. I think it was South 32. So we've seen commodity markets get absolutely hammered, yet there's a lot of producers out there who are continuing to produce at or near record production numbers. It's no wonder the commodity markets are getting hammered, and for the foreseeable future, until some of those producers start making the really tough decisions to reduce production, the commodities will head lower and will probably drag, equity markets lower as well.
So it's a commodity price story purely for why you're bearish in your view?
Yeah, well, one of the things that I looked at recently, now this isn't my research, I was reading it yesterday, the correlation between the S&P 500 at the moment and oil prices since oil prices slipped below $40 in December is at about 92%. In the last 5 years, the average was negative 73%, and over a 20-year period, it's only around 25%. So right now, it's as oil goes, seemingly so will equity markets. And coming back to that structural oversupply that I've been talking about, Iran coming online, the producers continuing to produce at record levels, as I was just talking about, that supply-demand equation might take years, not months, to come back to any sort of equilibrium. So that's why I think, yes, equity markets for the time being will definitely continue to be tied to oil and commodities, which I foresee heading lower.
Which does incidentally then feed in the right way to a Sydney airport model, which you are liking at this point. So if we cross over to where you're not such a bear, you're seeing upside there, you're seeing the weakening currency as a fillip for overseas visitors to our shores. We've seen those in recent tourism numbers. But beyond that, companies, Chris, with that crucial offshore exposure where a weaker domestic currency is only a fillip, presumably, have they run their course? Is that why you're not calling them out today?
Look, the lower Australian dollar will eventually provide a tailwind for any company, whether it be in the healthcare space, materials that has offshore earnings. But now there's more significant problems that are simply outweighing that. And the Aussie dollar probably has to fall maybe to 60 to get a significant benefit to push those companies higher. So it's certainly a factor, Carson, and definitely one that would be fed into the overall equation. But I just think right now it's not all that relevant.
That level of 60 is a pretty, well, you're back in the bear camp again. Who is realistically calling that one or expecting that? And if you are calling it, when are you expecting it by?
No, well, don't get me wrong. I'm not suggesting that it will get there. I just think that might be a level at which, that will become such a significant factor for companies with offshore earnings that it will supersede some of the factors that we're seeing now that are driving companies lower.
You've spoken a lot about commodities and obviously the story there, but what do you think about the banks, the other big sector on the Australian market? Are you bearish on the banks as well?
I actually don't mind the banks at the moment. They're on a grossed up yield of around 10%, but right now, given the sentiment, I wouldn't be a buyer of them. I think there's still some further downside to come for US markets, the Australian market, and indeed commodities, as I've just been talking about. If you're a short-term trader, I think it's very simple at the moment. You stick with the trend and you be a seller. If you're a medium to longer-term investor, you want to see some evidence that things are starting to turn around. So do you buy banks today? No, probably not. You might, if they bounce another 3, 4, 5, 6%, then you start looking at them more closely.
What about the near 5% fall in ANZ yesterday? Do you see that as a buying signal?
No. What is it up today? It's probably bounced back 2 or 3% today.
Not quite.
We need to see, I think, a more sustained move higher, but also some stability in some of those macro factors as well. China's devaluation of the yuan, there's commentary around that they're going to continue to devalue up to around 10 to 15%. The Chinese economy, yes, we got some good GDP numbers the other day, but it's still a worry. US earnings season, as we've already talked about, and indeed commodity prices. So some stability in those factors coupled with a more concerted bounce in the banks, I think that's your signal. Because again, if you're a medium to long-term player, you're looking to get a 30% move higher over the next couple of years rather than a 10% move over the next 6 months.
And they seem the most vulnerable, do they not, ANZ, to a dividend cut? That's the Morgan Stanley accepted wisdom.
That was why we saw it drop almost 5%. And actually it's only making back about 0.6% of that this morning. Chris Conway, we will leave it there with you. Thank you so much for joining us.
Thanks, guys.